Understanding derivatives, a guide to basic definitions and uses in finance. Presentation overview. Introduction to derivatives. Derivatives are financial instruments that derive their value from an underlying asset or benchmark. We'll explore the concept of derivatives and their history. Types of derivatives. There are different types of derivatives, including futures, options, and swaps. We'll explore each type and how they differ from one another. Use of derivatives. Derivatives are used for risk management, investing, and speculation. We'll discuss each use in detail and how derivatives can be used effectively. Introduction to derivatives. Derivatives are financial instruments that derive their value from an underlying asset. They are used for risk management, speculation, or arbitrage. Forward contracts. Forward contracts are agreements to buy or sell an underlying asset at a future date and at a predetermined price. They are used to hedge against price volatility. Futures. Futures are standardized contracts to buy or sell an underlying asset at a future date and at a predetermined price. They are traded on exchanges and used for hedging or speculation. Options. Options are contracts that give the holder the right but not the obligation to buy or sell an underlying asset at a future date and at a predetermined price. They are used for speculation, hedging, or income generation. Definition and basic concepts. Underlying assets. The underlying asset is the asset from which the derivative derives its value. It can be a stock, bond, commodity, or other financial instrument. Notional value. The notional value of a derivative is the amount of the underlying asset covered by the contract. It is the basics for calculating the value of the contract. Expiration date. The expiration date is the date on which the contract expires. At this point, the contract is settled and the parties either exchange the underlying asset or pay the difference in value between the contract and the underlying asset. History of derivatives. Derivatives in ancient civilizations. Derivatives have a long history dating back to ancient civilizations, where they were used for trading commodities like rice and grain. These early derivatives paved the way for the modern financial derivatives market we know today. Rice futures in Japan. Rice futures in Japan were one of the earliest examples of a derivative market, where farmers and merchants used contracts to hedge against price fluctuations. This innovation helped stabilize the rice market and paved the way for modern commodity futures markets. Commodity markets of the 19th century. Commodity markets emerged in the 19th century as a way for producers and consumers to manage price risks. These markets paved the way for the modern derivatives market, which has expanded to include a wide range of financial instruments. Types of derivatives. Futures. Futures are derivatives contracts that obligate the holder to buy or sell an asset at a predetermined future date and price. They are commonly used to hedge market risks. Forwards. Forwards are similar to futures, but the terms of the agreement are negotiated between the buyer and the seller. They are often used in foreign exchange trading. Options. Options are contracts that give the holder the right but not the obligation to buy or sell an asset at a predetermined price and date. They can be used for speculative purposes or as a risk management tool. Swaps. Swaps are agreements between two parties to exchange cash flows based on different financial instruments. They can be used for hedging or to take advantage of differences in interest rates. Futures. Definition of futures. Futures are contracts that require the buyers purchase an underlying asset at a future date for a set price. They are widely used for hedging and speculation. Margin requirements. Margin requirements are the minimum amount of cash that a trader must deposit to enter into a futures contract. Margin requirements vary depending on the underlying asset and the exchange where the contract is traded. Delivery date. Delivery date is the date in which the underlying asset must be delivered to the buyer. Delivery dates are specified in the futures contract and typically occur on a monthly basis. Contract size. The contract size specifies the amount of the underlying asset that is being traded in the futures contract. Contract sizes vary depending on the underlying asset and the exchange where the contract is traded. Forwards. Customized contracts. Forwards are customized contracts between two parties based on their specific needs. They differ from futures contracts, which are standardized and traded on an exchange. Delivery date. Forward contracts have a specific delivery date, which are agreed upon by both parties. This date can be weeks, months, or years in the future, depending on the nature of the contract. Contract size. Forwards contracts can be customized to suit the needs of both parties, including the size of the contract. The contract size can be tailored to fit the specific needs of the buyer and the seller. Credit risk. Forwards contracts carry credit risk, which is the risk that one party will default on the contract. This risk can be minimized by requiring collateral from the party with the weaker credit rating. Options features. Options are financial instruments that give the holder the right but not the obligation to buy or sell an underlying asset at a set price. Options have several key features, including strike price, premium, and expiration date. Strike price. The strike price is the price at which the holder of an option can buy or sell the underlying asset. It is set at the time the option is bought or sold. Premium. The premium is the cost of buying or selling an option. It is determined by the market and depends on various factors, including the underlying asset, volatility, and time to expiration. Expiration date. The expiration date is the date on which an option expires. After this date, the option cannot be exercised and becomes worthless. Swaps. What are swaps? Swaps are contracts between two parties to exchange cash flows based on an underlying asset, such as interest rates or currencies. Interest rate swaps. Interest rate swaps are a type of swap agreement in which two parties agree to exchange interest rate payments based on a notional value. Currency swaps. Currency swaps are a type of swap agreement in which two parties agree to exchange cash flows denominated in different currencies on a notional value. Use of derivatives. Risk management. Derivatives are often used to manage risk in various financial transactions, such as hedging against price fluctuations in commodities or currencies. Investing. Derivatives can be used to invest in various asset classes, such as commodities, stocks, and bonds. It can provide investors with opportunities to maximize their returns. Speculation. Derivatives are also used for speculative purposes, where traders aim to profit from price movements in the underlying asset without owning it physically. Risk management. Derivatives are financial instruments that can be used to manage risk, such as hedging against currency fluctuations or commodity price volatility. Investing. Derivatives can be used to gain exposure to different asset classes or to take advantage of market trends, but they also carry significant risks for investors. Understanding these risks is essential for successful investing. Speculation. Using derivatives for speculation. Derivatives can be used for speculative purposes such as betting on the direction of a stock or commodity price. This can lead to high potential rewards, but also involves a lot of risks. Potential rewards. Using derivatives for speculation can lead to high potential rewards, such as high returns on investments in a short time frame. However, these rewards come with high risks and may result in significant losses. Risks involved. Derivatives trading for speculation can lead to significant losses as well. The risks involved include market volatility, leveraged positions, and not fully understanding the underlying assets. Conclusion. Derivatives are complex financial instruments that have revolutionized the world of finance by providing investors with a variety of tools for managing risk, investing, and speculation. With the increasing complexity of the global financial system, derivatives have become an integral part of the financial landscape. Thank you.